You're 37 years old, scrolling through social media, and you see a post from someone your age who just retired early. Another friend just bought their second rental property. Your college roommate is talking about their six-figure investment portfolio. And you look at your own financial situation, $18,000 in your 401k, $3,200 in savings, still paying off $22,000 in student loans, and you just realized you're closer to 40 than you are to 30. You think, where did the time go? I thought I'd have it together by now. You're making decent money, maybe $75,000 a year, but somehow you're not where you thought you'd be financially. And here's the brutal truth. Your 30s are the make or break decade for wealth building. And if you hit 40 without making these 7 critical moves, catching up becomes exponentially harder. But here's the good news. If you're watching this and you're in your 30s, you still have time. By the end of this video, I'm going to show you the exact 7 money moves you need to make before 40 to set yourself up for financial success instead of spending your 40s and 50s playing catch up and stressed about money. My name is Max, and I want to help you learn how to make your money work more for you in your life. Today, I'm breaking down the 7 specific financial milestones and decisions that separate people who enter their 40s financially secure from those who enter struggling, so you'll know exactly what to prioritize in the time you have left before this critical decade ends. So let's get started, and please make sure to hit the subscribe button and give this video a thumbs up if you like it. Why your 30s matter so much. Here's the thing. Before we dive into the 7 moves, you need to understand why your 30s are so critical for wealth building. According to research from Fidelity Investments, your 30s represent the highest leverage decade for retirement savings. Money invested at 30 has 35 years to compound before retirement at 65. Money invested at 40 has only 25 years. That 10-year difference is massive. Let me show you the math. If you invest $500 per month starting at age 30, at 8% returns, you'll have approximately $1.04 million at 65. If you wait until 40 to start that same $500 per month investment, you'll have only $447,000 at 65. Waiting 10 years cost you $593,000. Additionally, your 30s are typically when your income starts accelerating. According to Bureau of Labor Statistics data, median earnings jump significantly from ages 25 to 34, $54,000, to ages 35 to 44, $65,000. But most people experience lifestyle inflation that consumes this increase instead of directing it toward wealth building. Your 30s are the decade where you either build momentum that carries you to financial freedom, or you waste your highest earning, highest compound growth years and spend your 40s and 50s trying to catch up. Let's make sure you're in the first category. Move number 1, eliminate all consumer debt. Okay, the first move you need to make before 40 is eliminating all consumer debt. Credit cards, personal loans, car loans, buy now, pay later schemes, all of it, gone. Here's what most people don't realize. Carrying consumer debt into your 40s is like trying to run a marathon with a 50-pound backpack. You can do it, but you're making everything unnecessarily harder. According to the Federal Reserve, the average American with credit card debt carries about $6,200 in balances. At typical interest rates of 20 to 24%, that costs approximately $1,240 to $1,488 per year in interest alone. Over 10 years, that's $12,400 to $14,880 paid just in interest. Money that could have been invested and grown to over $100,000 by retirement. But it's not just the math. It's the psychological weight. Debt creates stress, limits options, and keeps you in a defensive financial position instead of offensive wealth-building mode. How to accomplish this? Use the avalanche method. List all debts by interest rate and attack the highest rate first while making minimums on everything else. Cut discretionary spending to bare bones temporarily. Increase income through side work or job changes. Throw every extra dollar at the debt. For someone with $15,000 in consumer debt paying $600 a month, you can be debt-free in 28 months. Yes, that's hard. Yes, it requires sacrifice. But entering your 40s with zero consumer debt means you can redirect that $600 per month toward investments for the rest of your working life. The transformation, going from $15,000 in debt to $0, doesn't just save you interest, it frees up cash flow that can build $500,000 plus in wealth over the next 25 years. Move number 2, have your annual salary saved for retirement. The second move is hitting the 1x benchmark. By age 35, you should have at least 1 times your annual salary saved in retirement accounts. By age 40, you should have 2 to 3 times. This benchmark comes from Fidelity's retirement savings milestones. And here's why it matters. If you're on track at these checkpoints, you'll be on pace to retire comfortably. If you're behind, you need to course correct immediately. Let's say you're making $80,000 per year. By 35, you should have $80,000 in retirement accounts. By 40, you should have $160,000 to $240,000. According to the Federal Reserve, the median retirement account balance for Americans aged 35 to 44 is only about $45,000. That means most people are dramatically behind. Why this is critical. Retirement savings in your 30s benefit from 25 to 35 years of compound growth. Every dollar you invest now is worth 4 to 10 times more at retirement than a dollar invested in your 50s. If you're 35 with only $20,000 saved and you're making $70,000, you're behind. You need to get aggressive. Increase your 401k contribution to 15 to 20% of income, max out your employer match. Open a Roth IRA and contribute the maximum, $7,000 per year. This is where it gets really interesting. Getting from $20,000 to $70,000, 1x your salary, by contributing $1,000 per month takes about 4 years with 8% returns. It's achievable if you start now. The transformation. Hitting this milestone means you're on track for retirement. Missing it means you'll need to save 25 to 30% of income in your 40s and 50s to catch up, which is much harder. Move number 3. Build a 6-month emergency fund. The third move is building a fully funded emergency fund that covers 6 months of essential expenses. Your 30s are when life gets complicated and expensive. You might have kids, a mortgage, aging parents, health issues. Without a substantial emergency fund, any one of these can derail your entire financial plan. According to Bankrate, only 44% of Americans could cover a $1,000 emergency with savings, but by your late 30s, $1,000 emergencies are routine, car repairs, home maintenance, medical bills. 6 months of expenses means if your essential monthly costs are $4,000, you need $24,000 in liquid savings. If they're $5,500, you need $33,000. Why this matters, this fund isn't just for job loss. It's for every scenario that requires financial flexibility. Taking time off for family, handling a medical crisis, weathering a period of reduced income, or even taking advantage of opportunities that require short-term sacrifice. Additionally, having this fund eliminates financial anxiety. You're no longer one surprise away from disaster. You can make better career decisions, negotiate harder, and take calculated risks. How to build it. If you're starting from zero, this feels overwhelming, but break it down. Saving $1,000 per month gets you to $24,000 in 24 months. Saving $1,500 per month gets you there in 16 months. Find the money by eliminating debt payments, move number 1. Cutting lifestyle expenses and increasing income, move number 4. The transformation. This fund changes your entire relationship with risk, stress, and opportunity. It's the foundation everything else builds on. Move number 4, increase your income by 50% from where you started your 30s. The fourth move is strategic income growth. By the end of your 30s, you should be earning at least 50% more than you were earning at the beginning of the decade. If you were making $50,000 at 30, you should be making $75,000 plus by 40. If you started at $65,000, you should be at $97,500 plus. Here's the thing. All the other moves become dramatically easier when your income grows. Saving 15% of $50,000 is $7,500 per year. Saving 15% of $80,000 is $12,000 per year. That $4,500 difference compounds to hundreds of thousands by retirement. According to data from PayScale, workers who stay in the same job for more than 3 years earn significantly less than workers who strategically change jobs. Average annual raises for staying put, 3%. Average increase from switching jobs, 10 to 20%. How to accomplish this? Strategy 1. Develop high-value skills in your field. Identify what skills command premium compensation and systematically develop them through courses, certifications, or project experience. Strategy 2. Switch jobs strategically every 2 to 4 years if there's no path to significant raises at your current company. The market rewards movement more than loyalty. Strategy 3. Negotiate aggressively. Most people accept the first offer. Countering adds 5 to 15% on average. Strategy 4. Consider side income streams, freelancing, consulting, or a small business that supplements your primary income. The transformation. Income growth accelerates every other financial goal. More income means faster debt payoff, faster emergency fund building, higher retirement contributions, and more flexibility in life. Move number 5. Max out tax-advantaged accounts. The fifth move is maximizing tax-advantaged retirement accounts, specifically maxing out your 401k $23,000 per year in 2024 and Roth IRA $7,000 per year. Here's what most people don't realize. The tax savings from these accounts compound over decades into six-figure differences. Let's compare two scenarios over 25 years. Scenario A, taxable account. Invest $30,000 per year in taxable brokerage. Pay 15% capital gains tax annually on growth. After 25 years at 8% pre-tax returns, 6.8% after tax, $1.86 million. Scenario B, tax-advantaged accounts. Max 401k, $23,000 per year. Max Roth IRA, $7,000 per year. Total, $30,000 per year. No taxes on growth, Roth, or deferred taxes, 401k. After 25 years at 8% returns, $2.37 million. The tax-advantaged approach gives you $510,000 more. Same contribution, massive difference. Additionally, 401k contributions reduce your current taxable income, lowering your taxes now. If you're in the 24% tax bracket and contribute $23,000, you save $5,520 in taxes this year. How to accomplish this? If you can't max out both immediately, prioritize 401k up to employer match, free money. Roth IRA to the max, $7,000. 401k to the max, $23,000. Taxable brokerage for anything beyond. Increase contributions by 2% every 6 months until you hit the max. The transformation, maxing these accounts in your 30s sets you up to retire a millionaire. Not doing it means you'll struggle to catch up later. Move number 6, get your net worth to $100,000. The sixth move is reaching $100,000 in net worth, the point where compound growth becomes visible and wealth building momentum accelerates. Net worth is everything you own minus everything you owe. At $100,000, you cross into six figures, and psychologically and mathematically, everything changes. According to Charlie Munger, the first $100,000 is the hardest money you'll ever save. But once you hit it, the next $100,000 comes much faster because compound growth accelerates. When your net worth is $10,000 earning 8%, you gain $800 per year in growth. When it's $100,000, you gain $8,000 per year. That's $667 per month you didn't have to work for. How to get there? Track your net worth monthly. Focus on the big levers. Eliminate debt, increases net worth. Save and invest consistently, increases assets. Avoid lifestyle inflation as income grows, maximizes the gap. From $0 to $100,000, saving $1,500 per month with 8% investment returns takes about 5 years. If you're 35 and starting from zero, you can hit $100,000 by 40 with focused effort. The transformation. Crossing $100,000 creates psychological momentum. You've proven you can build wealth. The next $100,000 to $200,000 takes only 3 to 4 years. Wealth building accelerates exponentially. Move number 7. Make a plan for kids' education, if applicable. The seventh move, if you have or plan to have kids, is creating a realistic plan for education funding without destroying your retirement. According to the College Board, the average cost of 4 years at a public university is now over $100,000. At a private university, it's over $200,000. Here's the critical rule. Never sacrifice your retirement to pay for your kids' college. There are loans for education. There are no loans for retirement. The strategy: open a 529 college savings plan and contribute what you can afford without compromising retirement savings. Even $200 to $300 per month per child, starting in their early years, grows significantly by age 18. $300 per month from birth to age 18 at 7% returns, approximately $116,000. That covers a significant portion of public university or a chunk of private school. But if you can only afford $100 per month without impacting retirement, that's fine. Your kids can work part-time, apply for scholarships, or take some loans. They have their whole lives to earn. You don't. The transformation. Having a plan removes guilt and anxiety. You're contributing what you can without sacrificing your financial security. Now, you're probably wondering, Max, I'm 36 and I haven't done most of these. Am I screwed? No. But you need to get aggressive immediately. If you're behind, here's your priority order. Eliminate consumer debt. Move number 1. Build emergency fund to $5,000 minimum. Move number 3. Get 401k to employer match, plus Roth IRA contributions. Move number 5. Aggressively increase income. Move number 4. Build emergency fund to full 6 months. Move number 3. Max out retirement accounts. Move number 5. Push toward $100,000 net worth. Move number 6. You might not hit all 7 moves by 40, but hitting 4 to 5 puts you dramatically ahead of most people. Additionally, let me show you what happens if you don't make these moves in your 30s. Person A makes the 7 moves by 40, 0 consumer debt, $160,000 in retirement accounts, $30,000 emergency fund. Income grew from $55,000 to $85,000. Net worth, $200,000. Age 40 to 65, continues investing $1,500 per month. Retirement at 65, $2.8 million. Person B delays until their 40s, still has $12,000 consumer debt at 40, $35,000 in retirement accounts, $4,000 emergency fund. Income grew from $55,000 to $62,000. Net worth, $27,000. Age 40 to 65, tries to catch up, invests $2,000 per month, harder with kids, obligations. Retirement at 65, $1.4 million. Person A has twice the retirement wealth despite investing less per month because they started building the foundation in their 30s. Look, here's what I need you to understand. Your 30s are the decade that determines your financial future, not your 20s. Most people are still figuring things out then, not your 40s. By then, you're trying to catch up. Your 30s are when you have enough income to build wealth, but enough time for it to compound into life-changing amounts. If you're in your early to mid-30s watching this, you have time to make all 7 moves. If you're 38 or 39, you might not hit all of them, but you can hit the most important ones and set yourself up for a strong 40s. And if you're already past 40, these moves still matter. Just adapt the timeline and get started immediately. The people who enter their 40s financially secure aren't lucky. They're not smarter. They made these 7 moves in their 30s. While everyone else was buying cars they couldn't afford and living like they had unlimited time, you don't have unlimited time. You have what's left of this decade. Use it. If this video gave you a clear roadmap for what you need to accomplish before 40, here's what I want you to do. First, screenshot or write down these 7 moves. Put them somewhere you'll see daily, your phone wallpaper, your bathroom mirror, your desk. Make them impossible to ignore. Second, calculate where you currently stand on each move. Be brutally honest. You can't fix what you won't acknowledge. And third, pick the one move you're furthest behind on and commit to making progress this month. Don't try to fix everything at once. Pick one and take action. Fourth, if you know someone in their 30s who's drifting financially, spending everything they make, not thinking about the future, making excuses, send them this video. You might save them from decades of financial stress. And if you want the complete playbook for building wealth in every decade of life, subscribe to this channel. Every week, I'm breaking down what actually works versus what keeps people broke. Your 30s are running out. The decisions you make in the time you have left will echo for the rest of your life. Make them count. Thanks for watching. Now go make these moves happen.